So today was a rough day for the US stock market. The Dow was down to almost 26,000 even. It was down almost 500 full points, down 494 points it closed at, down 1.86%. The VIX is still going up. Yesterday it was up, I think, around a little over 14%. Today it was up another 10.78%. So the whack-a-mole hammer could be coming at any time soon. This is very rare for the VIX to have continual multiple days up, and the dollar index is holding above 99 at 99.02. President Trump had his press conferences today. He's clearly blaming the Democrats for the stock market and some of the other problems. The talking heads on mainstream financial media are blaming General Motors for the bad manufacturing data, which General Motors has only, the United Auto Workers there have only been on strikes for 2 weeks, and yet that's being the excuse du jour, the main part of the blame. But the main reason I wanted to do this show today, and I had other shows planned, but when there's breaking news or my research comes up with more interesting topics, I switch around the schedule. So today's topic will be on the Federal Reserve's balance sheet. So last month, there was a lot of people in the gold community, a lot of alternative media people who are going all crazy because the Federal Reserve had increased their balance sheet by $14 billion. And on a $3.7 trillion and change balance sheet, $14 billion now is not a big deal. However, things have changed a lot. I was just on the St. Louis Federal Reserve website last night checking their balance sheet. They have not updated it yet this week, but I was running the numbers and I have a chart for you guys to take a look at there. And I put a circle when Repo Madness officially started, which was late on September 16th, and we started getting articles about it on September 17th. So that's the circle there. But now the official Federal Reserve balance sheet, guys, is up almost $100 billion in barely a month. So it's not even a month, and the official Federal Reserve, because we're not to October 4th or 5th or 6th, which is when the real spike started, but the official Federal Reserve balance sheet is up almost $100 billion in a single month. We'll see if this continues on an annualized basis. The question is, what are they buying? Because we know that they were dumping mortgage-backed securities. They were telling us that Repo Madness is not permanent, that Repo Madness is not QE, that everything is overnight, all the collateral is good, and yet here the Federal Reserve's balance sheet is going up. The exact amount of the Federal Reserve's balance sheet is going up. The official number on the St. Louis Fed website is, the latest number they have, the official number is 3.857715 trillion, and the increase in the Federal Reserve's balance sheet, it bottomed out around 3.759946 trillion. So that's around a 97.769 billion increase. So almost $100 billion. So the question is, what are they buying? And is it part of the Repo Madness program, or are they stepping in for treasury auctions? We don't know. And unfortunately, if they say one thing, we're not going to get full transparency here. This is not part of the game. They don't want full transparency. In fact, if you don't believe me on that, go and listen to the interview behind the paywall on Real Vision TV and listen to two former Dallas Federal Reserve Bank employees, Danielle DiMartino Booth, who does sometimes criticize the Fed and is sometimes a Dallas Fed apologist, and then another former Dallas Federal Reserve Bank employee, George Goncalves, and they're talking about how the Fed needs to rebrand, change the name of quantitative easing, so it's easier to hide from the regular people out there. So they can improve their image and rebrand the thing. So just more craziness. We'll see if this balance sheet increases continues on this pace. Again, there's no guarantees that it will continue on this pace, but the gold community and the alternative media, I think, was premature when they said that at $14 billion, they were saying it's QE, they're increasing their balance sheet, they were getting all spooked. This was almost a month ago. It was way too early. So 14 billion balance sheet increase officially versus now almost right around, if you round up, 98 billion. 98 billion, and the dollar index is strong. The gold price, like I said, I was going to do another show on this, but the gold price is a combination of Manipulation in the gold price, options expiry, which I think ended yesterday, and then also there's a holiday in China, well, holiday in air quotes, for the Chinese Communist Party, the 70-year anniversary. I wouldn't consider it a holiday, but that means that the Shanghai Gold Exchange is shut down temporarily. I'm not sure exactly when it restarts, but I believe it was shut down for around a week. So when China comes and the paper gold market is almost always hit. It is almost always smashed. Paper prices are when Chinese physical gold buying and Chinese physical silver buying shuts down. However, the gold price did have a rally today. So volatility was up. The dollar index was up. Stocks were down almost 2% today. The Dow was down almost 2% today. And gold did have a little bit of a rally in US dollars. We'll have to monitor the Fed's balance sheet to see. No, of course they lied. This is what happens when you don't have independent audits and accountability and transparency. And none of the employees at the Federal Reserve are held to account. There's no accountability there. They get Cadillac healthcare, Cadillac pensions. A lot of them have pensions already from academia. They go and work at the Federal Reserve, they get another pension. So these guys are routinely wrong with all their models and predictions, and they're collecting 2 or 3 pensions. Janet Yellen and her husband, I think I remember reading, had about 6 pensions between the two. So Janet Yellen and her husband were career academics. She has a career of being wrong with all of her models, all of her predictions, and yet she was worth well over $5 million, her and her husband together. Jesse says the Fed lies just like China. Yeah, it's management of perception economics, MOPE. Everyone's lying. It's debatable exactly how much. Actually, there's another story. I'll do another short video on this in the next couple days. And the story was someone ran the numbers and he found in government data that now all the government taxes you pay, if you're an American citizen, all the federal, state, and local taxes you pay are now more than the average American spends per year on food and healthcare and clothes. And if you add in the stealth tax, the inflation tax, the amount of taxes everyday Americans are paying per year is 50% or more, depending upon which state and city and county you live in. Oh, thank you for the super chat, Paul. I appreciate it. OMP. Let me take a look. I haven't looked at OMP. So these are the pipeline companies, the master limited partnerships, and there's big tax problems with those. So I used to cover MLPs years ago, about 6 years ago, when I worked as an investment analyst. That was my day job at Investing Daily. And I worked with Robert Rapier and some of the other oil and energy writers there for a while. And we covered MLPs. And a lot of the people who invested in them, they always had enormous tax questions. That was probably the main problem with MLP. So there's big tax issues. If you buy these MLPs, you're looking at big tax hits. The average tax accountant can't file a K1. You're looking at doubling your tax bill, and your tax accountant's going to be sending you really nasty phone calls and emails. So I think the MLP industry, this was under Ronald Reagan. They were given the ability to switch to master limited partnerships, and then people who bought those shares had to file K1s every year, and it was a real pain in the ass. But supposedly you didn't have to pay taxes on them if you didn't sell your shares, if you just buy and held them. And then if you died and passed your shares onto a relative, I think you delayed the tax burden even further. But I think those tax laws are changing. So not only is there structural problems with those pipelines. So the pipeline companies, Paul, especially if they're up there in the Bakken, that oil production could come under pressure. It just depends how much of a bailout some of these companies because Oasis, you have to see which pipeline companies, which oil production companies are sending oil through the pipeline and how much in trouble they are. Because just because the oil pipeline companies have take or pay contracts does not mean that the oil producer can fulfill them. Yeah, pass-through is like a toll. Yeah, but that's the thing, though. So they tell you that it's a lot safer, but then if the company that's producing the oil that goes through the pipeline, they get in trouble, then the oil stops going through the pipeline. And then the pipeline company, which used debt to build the pipeline, then they're in trouble, too. a lot of these pipeline companies got into a lot of trouble. There's tax problems with the pipeline companies. I haven't checked on this at least in 8 months on the exact tax problems with the pipeline companies, so don't quote me fully. Again, this is just my opinion, not financial advice. But thank you for the super chat. If you have any more questions, I'll send some research. I'll email me if you have any more questions. Thank you for the super chat, though. But what I would suggest, not financial advice, suggest for research is go and find the oil producers that are sending the oil through the pipeline, and then you have to check the balance sheets and the margins and the costs and the cash flow and how healthy the oil producers are that are sending oil through that pipeline company. And if those oil producers are in bad shape, unless they get a bailout or a larger oil producer comes in and buys them and saves them, then what happens is if the oil production drops, the pipeline company is in trouble too. The dividend will be cut, the shares will be cut in half. There's a lot of bad stuff that could happen. Again, I'm not sure. I haven't looked at this company specifically. I'm just talking about when the pipeline companies, the MLPs, those types of midstream MLPs get in trouble historically. So you got to find out who's their counterparty risk, which oil producers are sending oil through their pipeline, and how badly in trouble those producers are. Because if it's, okay, I haven't researched this, but if it's Oasis Petroleum that's below $3 a share, I'm not sure what the share price is, but if the share price is, I haven't looked at it in a week or two, but if the share price is below $3 a share, the share price is low, the company's losing money, and they're the ones that are sending, Oasis Petroleum is the one sending the oil through the pipeline of Oasis Midstream Partners, and they're in trouble with bankruptcy, and they cut production, or they can't get a bailout, or they can't raise cash, they can't sell shares to raise cash, then if that oil production doesn't go through the pipeline, then the pipeline company is in trouble too. No, I said it's not, but they're related. So this is what the oil companies are doing, Paul. They're related. So what these companies did, because the pipeline companies were getting, I'm getting way off on tangent here, but I got a $50 super chat, so I'm attempting to answer his question fairly thoroughly. So please bear with me for another minute or two. So what the oil producing companies did to get more valuations is very similar to what the gold and silver miners did, spinning off royalty and streams. They're producing royalty and streams, how Pan American Silver spun off their royalty and streams to Maverick Metals, and that has a really high market cap. And the oil and gas companies spun off their pipelines into separate. So the oil and gas companies then would produce the oil and gas, and then they spun off their pipelines, which they owned previously through the entire regular company shares, and they spun those off into MLPs, and then they moved their oil through the pipeline companies, and the pipeline companies were paying dividends and got a higher valuation. Now, there's big tax problems with the MLPs, and if the production levels and the counterparty risk for the pipeline companies is bad, those safe cash flows, those safe dividends, that can start in a hurry. So the two biggest risks for me are tax problems with the tax changes for the MLPs, because the K1s, they've talked about changing the tax. I haven't checked on this recently. And then also the second one is the counterparty risk for the producers of the oil. How bad of financial trouble are they producing oil? How bad of financial trouble are the counterparties? Are the oil companies producing at good margins, making free cash flow? Okay, so hopefully I answered your question halfway decently, Paul. Thank you again for the super chat, much appreciated, and thank you very much to my 150 Patreon account contributors, or there was over 150. I think like 6 or 7 people canceled in the last 3 days. Oh well, nothing I can do about that. Just got to keep growing the channel then, right, to get it up to 50,000 YouTube channel subscribers, and hopefully I can get to 200 Patreon account contributors then. So, the Fed balance sheet. We're going to have to check this. I'm going to have to monitor this. I will attach a link to the website so you can monitor this yourself. So you don't have to email me, Jason, what's the Fed? Jason, what's the Federal Reserve's balance sheet now? It's really easy. You can check it yourself for free. This is only the official number. Again, we're not going to find out the real number without any type of real independent audit. We don't know any of their currency swaps or any of that other stuff. But I think the gold community and the alternative media a month ago were getting way ahead of themselves, hyperbolic. It was way ahead of themselves when the balance sheet was only at 14 billion, and now here we are almost 100 billion up in a month. So I think now it's time to see red flags, because we're being told that repo madness is only temporary. But what is the Fed buying? Are they stepping in for treasury auctions? Are they actually, is the collateral that's being used for repo madness not quote unquote good collateral? Is it what I suspect, my educated guess, is it some of this collateralized loan obligation garbage? My guess is eventually at some point, I don't know timing on this, but probably in the next few years, if I had to make an educated guess, that the Federal Reserve will have to buy a large chunk or all of these collateralized loan obligations. They are that toxic. And the reason I use toxic sausage is because these leveraged loans, these junk bonds, which often have no debt covenants, so they have little or no collateral. They're called quote-unquote covenant light, and these junk bonds are chopped up into pieces just like mortgage-backed securities, and they're packed together just like sausages, because they tell you to not ask. If you like sausage, they tell you to not ask what's in the sausage, all the ingredients in the sausage. So that's why I call it toxic sausage, because CLOs and these other derivatives are toxic. They are the financial equivalent of toxic sausage. And there's a lot of bad stuff in there. I don't even think the ratings agencies know exactly what's in there, because I've gotten some from a Brave Insider working at one of the ratings agencies. I got some copies of ratings guidelines and internal documents, seeing how they stuff with no debt covenant, stuff that should not be rated, junk bonds and leveraged loans that should not be rated. They're so bad they should not be rated at all, are rated CC. And then added into the models, and in the same bullshit that happened with subprime mortgage-backed securities, how there was mortgages, there was ninja loans and other garbage in there that they knew would fail, and the ratings agencies, the three major ratings agencies, still rubber stamped it AAA. And I suspect that the exact same stuff is happening now with collateralized loan obligations. And there is insurance companies in the US and Europe and Japan. There's banks, there's pension funds who are buying this stuff. I see a lot of talk about Bitcoin in here. My educated guess is that China is shorting Bitcoin and other cryptocurrencies. I think the Chinese government is, and I think that's to dissuade a lot of Chinese citizens from hodling, from either buying cryptocurrency or hodling it, as China transitions to their government cryptocurrency. And China already has a lot of Bitcoin mining there, although I saw in the last couple of years that because of energy costs and other threats by the Chinese government, that a lot of Chinese Bitcoin miners were leaving the country in the last few years anyways. Again, this is not financial advice to buy and hold Bitcoin. My educated guess is that Bitcoin is being manipulated. Just my opinion. Not financial advice to buy and hold Bitcoin. But I do I do have a wallet address if you want to tip me a little bit of Bitcoin or Litecoin or Bitcoin Cash. And I think I have like 3 other cryptocurrency wallet addresses. So the official Repo Madness, we started to hear rumors of it on Twitter and the internet on September 16th. That was a late Monday night. And by Tuesday, September 17th, we had a lot of articles coming out about Repo Madness starting. And I have it there on the chart, the circle. So the Federal Reserve, my educated guess now, again, I don't know this for sure. I don't think anyone would who wasn't working at the Fed or without an audit, a proper independent audit. But my educated guess is the Fed has known about the repo problems because there was a research report by the Fed, St. Louis Fed, in March predicting the repo problems, that they would get a lot worse, and asking for a larger permanent repo facility. And so the repo problems actually started before late Monday night, September 16th of 2019. And they probably started a week or two before that. And that's probably why the Fed probably came in. Or it could be based on problems with treasury auctions and the Fed stepped in. But I don't know if we'll ever get the real honest answer about why the balance sheet has expanded so much so quickly. But the Fed is dumping mortgage-backed securities still. There was a cap amount, I believe, of like $20 billion, that they were only supposed to be able to dump $20 billion per month in mortgage-backed securities, and they were selling over that for quite a bit over that. I think it was upwards of $30 billion per month they were selling. to try to clear room for buying treasuries and maybe other toxic garbage like perhaps collateralized loan obligations. And the more I look at collateralized loan obligations, and I think the Bank of International Settlements is even worried about collateralized loan obligations or CLOs, because in their latest quarterly update macro report that came out a couple weeks ago, they had pages and pages talking about collateralized loan obligations and how they're worried about it and all the problems it could cause. So I think the Bank of International Settlements is worried about it, so I think other people are going to start to get worried about it now too. And hedge funds have been, Bloomberg ran a story in the last couple weeks that hedge funds have been speculating on that. And then as indirect counterparties to the hedge funds, the investment banks who clear trades and are prime brokers for the hedge funds, they have exposure indirectly now if the hedge funds that have leveraged up, that the investment banks have given a lot of margin to these hedge funds leverage to go and buy the CLOs. So what a hedge fund normally does, if you're not familiar, is a hedge fund will to try to boost returns, to try to increase returns in the short term, to show off to investors, and this can backfire. And normally they don't even hedge the trades for safety. So hedge funds aren't really hedged. They're just leveraged bettors. And hedge funds, normally what they will do is, if they're going to copy someone like Stanley Druckenmiller on his long treasuries, long U.S. treasuries, short the stock market, zero interest rate policy bet trade, with Stanley Druckenmiller announced publicly, I think in March or April. And the 10-year U.S. Treasury yield went down a lot. I think from October last year, it went from like 2.7 something down to as low as, I think, almost 1.447% or something, since it started to reverse. And the 10-year U.S. Treasury yield, let me just take a look really quick, is at, pulling it up, it's back up to 1.5960. So some people took profits on that trade with leverage, and some people who are leveraged, maybe they increased leverage as the trade became more profitable they were greedy. They probably didn't hedge. Even though hedge funds are called hedge funds, a lot of them don't actually hedge. And they only bet one way, and with leverage normally, a lot of hedge funds, they don't actually hedge. And so now that the yields on the 10-year have started to rise a little bit, if you're holding those treasury bonds at 10x leverage, 20x leverage, you start to get margin calls. You start to get hurt. You start to get forced selling. And that's why you can get a big spike back in the yields. Not only is the U.S. government selling more treasuries at treasury auction, but also because the hedge funds that bet are closing out their leveraged trades. And some of them have margin calls and they're forced to, by the margin clerk, close out the trades immediately, unless they can put up more margin. Okay, so I think that's all I wanted to talk about right now. The dollar is holding above 99. So despite all this stuff with Trump, despite all this stuff with the manufacturing data, so the Trump political stuff that the Democrats are trying with the looks like Steele dossier 2.0, and attempting with the impeachment. I think it'll die in the Senate. So even if the House passes it, I think the Senate will kill it. Despite that, the dollar index is still holding above 99. And from the Fed minutes, we could see the announcement of a permanent repo facility. And Danielle, as soon as the next Fed meeting here in October, and Danielle DiMartino Booth has said that a permanent repo facility would be, quote unquote, this is her interview behind the Real Vision television paywall that came out over a week ago, quote unquote, QE on demand. According to her, not according to me, according to her. Okay, excellent question here. What will it take to get the US dollar lower? My educated guess would have to be a combination of rate cuts, potentially 50 basis point rate cuts quickly, and also QE at the same time, an official announcement. The fact that the dollar is still strong is testament to me that the global economy, the data is just getting worse. So people are going defensive. Gold is starting. This is why gold, in my opinion, there's not financial advice. This is why, in my opinion, gold's not going to go too much lower. Gold may go a little bit lower, but there's a lot of smart money who are not gold bugs, who see all the problems with all these central banks and governments, and they're starting to become gold bugs, and they're buying the dips. So I think in order to weaken the dollar more, the U.S. would have to do a combination of, again, I'm not advocating this. I don't want this. Look, I don't want how, it's ridiculous. This is what I brought up. I didn't explain this great on yesterday's live stream show, but why I was criticizing Donald Trump and the Federal Reserve was Donald Trump is telling the Fed to weaken the dollar more, but the Fed's already weakened the dollar a lot. So Donald Trump is angry at the Fed for not trying to devalue the dollar faster. Well, the dollar's already lost a lot of its purchasing power over the decades, especially since the Federal Reserve was created. So I think the Fed would have to do a combination of more than one rate cut, not a 25 basis point rate cut. We're talking like 50 basis point rate cut, and then maybe a permanent repo facility announcement, and then maybe that QE will start in November or something. And that might weaken the dollar, or it might not. As a gold investor, as someone who is not invested in these very risky junior mining stocks, I honestly don't care. I own physical metal, not as an investment, but for insurance, savings insurance, and wealth preservation. So I'm not leveraged to the gold or silver price in a very risky way, where if the gold price goes down or the silver price goes down, all my gold and silver mining shares are going bankrupt because they can't raise money, or they went from making a profit a couple weeks ago back to losing money. I'm not gambling like that. I know a lot of people have. Inflation is already bad. There's really bad stagflation, and taxes are being layered on. I honestly think, Carl, that the average American pays depending upon where you live. So if you live in a state like California or New York, especially in like New York City or San Francisco, I think the average American there is paying well over 60% of their salary in taxes. And then add on the stealth inflation tax, it's massive. Don't I ever have good news? Well, it's my birthday in a couple days. I guess that's good news. I mean, I'm not a talking head on mainstream financial media getting paid 6 or 7 figures to blow smoke up you guys, you know what? That the stock market is going to keep going higher, that the U.S. economy is doing superbly, that the GM strike is the reason why the manufacturing data is bad. I'm not spinning things. So I'll hold off on another Repo Madness commercial for now. I could probably add something in there about the balance sheet increasing, the Federal Reserve's balance sheet increasing, but maybe I should wait until a permanent repo facility is announced. Although if you look at the daily repo amounts, we're not even at a month yet, because the official Repo Madness, guys, like I said earlier in the podcast, was on September 17th. So we're not even a month yet, and there's already been over $600 billion worth of daily repos. Now, supposedly all these are paid back. Supposedly, this is all good collateral. Who knows? Who knows? We may never know. Okay, well, I think that's it for right now. And we'll see what happens if I decide I want to do another show later tonight after I get back from the gym. But if not, I'll speak to you guys again tomorrow. Bye for now.